Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together. Market crash this Christmas. Are you ready? Why experts are warning about a Christmas market crash. As we approach Christmas, financial analysts are sounding alarms about a potential market downturn. A combination of factors including rising interest rates, inflation fears, geopolitical tensions, and slowing consumer spending are creating a perfect storm for a market crash. Seasonal trends. Historically, December is known for the Santo rally, where markets rise. However, this year could break the trend due to economic pressures. Key warning signs. Increased volatility in major indices like the S&P 500. Reduced corporate earnings forecast for Q4. Weak retail sales data despite the holiday season. Example, back in December 2018, markets experienced a sharp sell-off due to similar conditions, rising interest rates, and economic uncertainty. Investors who weren't prepared saw significant losses, but those who acted early managed to protect their portfolios. Why markets are more vulnerable this year? Understanding the economic pressure points. Unlike previous years, the markets are facing unique challenges in 2023. High inflation. Central banks are maintaining aggressive monetary policies to curb inflation. Interest rate hikes. Rising interest rates are increasing borrowing costs for businesses and consumers, slowing down economic growth. Consumer behavior. With household budgets stretched thin, holiday spending, a key driver of Q for performance, is expected to decline. Example, take the retail sector, for instance. In previous years, companies like Amazon reported record sales during Christmas. This year, consumer spending is down 15%, which could severely impact the stock prices of major retailers. Sectors most at risk. Which industries could take the biggest hit? Not all sectors are equally vulnerable in a market crash. Certain industries face heightened risks. Retail, slower holiday sales could drag down stocks of companies like Walmart and Target. Technology, rising rates often lead to a sell-off in high-growth tech stocks due to reduced future earnings projections. Real estate, high mortgage rates are slowing property sales, putting pressure on REITs and construction companies. Example, in 2022, when the Fed increased rates, tech giants like Meta and Amazon saw their stock prices drop by over 30%. Expect similar patterns if economic conditions worsen this December. Defensive sectors and safe havens. Where to invest when the market drops? During market downturns, certain sectors and asset classes perform better than others. Utilities, essential services like electricity and water remain stable during economic turbulence. Consumer staples, companies that produce everyday goods, for example, Procter & Gamble, are less affected by spending cuts. Precious metals, gold and silver often rise as investors flock to safe haven assets. Example, in the 2020 market crash, while tech stocks plummeted, gold surged by 20%, proving its value as a hedge against uncertainty. Signs of a crash. How to spot the red flags. Don't get caught off guard. Recognizing the early signs of a market crash can help you act quickly. Increased volatility. Watch for sudden, sharp swings in major indices like the S&P 500 and Dow Jones. Rising bond yields. Higher yields can indicate that investors are losing confidence in the stock market. Corporate earnings misses. Poor Q for earnings reports from major companies could trigger a broader sell-off. Example, before the 2008 crash, volatility indicators like the VIX spiked to record levels. Investors who noticed the signs early were able to shift their portfolios to safer assets. How to protect your portfolio. Strategies for weathering the storm. Preparing for a market crash doesn't mean selling everything, it's about smart adjustments. Diversify your portfolio. Spread your investments across sectors, geographies, and asset classes. Increase cash holdings. Keeping some cash allows you to buy undervalued assets during the downturn. Focus on quality. Shift to companies with strong balance sheets and consistent cash flow. Example, during the 2020 crash, Investors who diversified into bonds and held cash were able to capitalize on the recovery by buying stocks at a discount. The role of bonds during a market crash. How fixed income investments provide stability. Bonds often act as a cushion during market downturns. As equities lose value, investors tend to shift to safer assets like bonds, driving up their prices and stabilizing portfolios. Why bonds work in crashes? Bonds have an inverse relationship with interest rates, often rising in value when central banks lower rates to stimulate the economy. They provide consistent income through coupon payments, offering stability amidst volatility. Which bonds to choose? Government bonds. Consider Treasury bonds, for example, US Treasuries or Canadian government bonds for lower risk. Corporate bonds. Focus on high-quality, investment-grade bonds for slightly higher returns with manageable risk. Example, during the 2008 financial crisis, US Treasury bonds outperformed most asset classes, providing investors with a safe harbor when equities dropped by over 50%. The emotional side of market crashes. Avoiding panic and staying rational. Market crashes can be emotionally taxing, leading many investors to make irrational decisions. Understanding and managing these emotions is key to long-term success. Why investors panic? Loss aversion, the fear of losing money triggers emotional selling. Herd mentality, when others sell, it's tempting to follow suit. How to stay rational? Stick to your plan, have a preset strategy for downturns and avoid knee-jerk reactions. Turn off the noise, limit exposure to sensationalized media coverage that amplifies fear. Example, in the 2020 crash, many panicked and sold their investments at a loss. Those who stayed invested, or even added to their portfolios during the dip, saw significant gains during the recovery. Rebalancing your portfolio during a crash. Turning losses into opportunities. Market crashes often create opportunities to rebalance your portfolio and buy quality assets at discounted prices. What is rebalancing? Adjusting your portfolio's asset allocation to maintain your desired risk level. Example, if stocks drop and bonds rise, shift some bond profits into undervalued stocks. Timing matters. Avoid trying to time the bottom. Instead, rebalance incrementally as the market adjusts. Example, an investor in 2020 rebalanced by selling overvalued bonds and buying blue-chip stocks like Apple and Microsoft at a 30% discount. Within a year, their portfolio value soared. Lessons from past market crashes. What history teaches us about recovery? Every market crash brings lessons that can guide future strategies. By studying past downturns, investors can gain valuable insights into what works and what doesn't. Key lessons. Crashes are temporary. Markets have always recovered, even from the worst downturns. Patience pays. Long-term investors who stayed the course often outperform those who sold in panic. Historical perspective. The 2008 financial crisis, markets recovered within 3 years, with significant gains for those who held on. The 2020 COVID crash, the S&P 500 dropped 30% but rebounded to all-time highs within months. Example, in March 2020, Warren Buffett famously advised staying calm and buying undervalued stocks. His patience paid off as Berkshire Hathaway reported record profits in the recovery phase. Strategies for building wealth after a crash. The recovery phase turning crisis into opportunity. Once the dust settles, the recovery phase is where wealth is built. Use this time to position your portfolio for long-term growth. Focus on quality. Buy blue-chip stocks, ETFs, or index funds that are undervalued. Think long-term. Avoid speculative investments during recovery. Focus on companies with strong fundamentals. Diversify your income streams. Explore alternative investments like real estate or dividend-paying stocks. Example, after the 2008 crash, investors who bought index funds like the S&P 500 saw annualized returns of 10% over the next decade, significantly growing their wealth. Are you ready for the next crash? Market crashes are inevitable, but with preparation and strategy, you can turn them into opportunities for growth. Diversify your portfolio and include safe havens like bonds and gold. Stay calm and avoid emotional decisions. Rebalance during downturns to capitalize on discounted assets. Encourage engagement. What are your strategies for preparing for a market crash? Share them in the comments below. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss another investing tip. Thank you for watching Sapric Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.